And Julie, why don't you kick off and valiantly defend why it is that retail investors should be allowed?
Well, some of you will already know that my view is that wealth is not a skill set. And just because you're rich doesn't make you clever, and just because you're less well off doesn't make you thick. So my moral objection to regulations which block participation on the basis of how much wealth you already have is as simple as that. I think there was a real change, particularly in the UK, between the Financial Services Authority and the Financial Conduct Authority. And really the change in remit was to include effective competition. And we did lobby very hard as a group to say that the current regulations weren't fit for purpose. In a rapidly changing world where post-RDR we have more self-directed investors than ever before.
Yeah.
And really our premise was that people should be absolutely clear and must understand the risk they're taking, and perhaps it's the job of the regulator to ensure people understand the risk. But we would argue that it's not the regulator's job to tell you what level of risk you can afford to take, bearing in mind you can gamble and give away as much as you like.
So I'll actually start with agreeing on one point, and I promise that will be the last one. I mean, to your point on, they don't know what they're investing in, it's not different in public markets. So in the public markets, if a company is public, they can pick the, pink sheet, which I'm still struggling with the spelling of this, but pink sheet shares, and no one tells them anything, okay? So theoretically, there's no difference in early stage startups, okay? I mean, and yes, you have more information with IPO, with companies, it's in later stage companies, but you can't really say that Facebook, in terms of the maturity of the business model when they went public, is that much different than early stage startups, okay? So I think that's not the argument. I think the argument against that, and again, now we start the debate, is I would say I'm breaking that into three different subjects. One is theoretically, they should be able to access early stage investments. I'm not sure that's the top choice for the asset class for investors with not a lot of money. But theoretically, I agree. I mean, they should access this. What I object is to the way it's done now. So I think that basically there are three issues with the way it's implemented now, specifically in the UK and in some other places starting soon. One is, I don't think the system is doing too well in actually educating them what are the risks. That's one. So the point that they are very likely to lose the money, not that there is a possibility for them losing money. I mean, I looked at one of the leading sites, it said, this is a risky asset class, you might lose the money and you might make a lot of gain, okay? It's not you might lose your money, it's likely that you're going to lose your money if you invest in this company. So it's more than 50%, even for VCs to lose the money on a given deal. So that's one. The second is that I don't think they actually know how illiquid the investment is, unlike the market. So I assume that if you survey investors that are active on the platforms and you ask them, so when do you think the exit will happen? Very few will say that the average time to exit on early stage startup is 7 years, and understand that they're basically stuck with this worthless piece of paper until that happens. And again, one of the sites said something like, it might take, you need to understand that this is illiquid, it might take a few years in some cases. No, it's actually going to take a few years, and if it's lower than that, then it's likely that's a scenario that you actually just lost your money. So that's the second thing. And the third thing in terms of education, I'm not sure that the system does a good job in educating them on the importance of diversification. And the regulations, I don't think, actually demand the systems to do that. So that's one subject. I have two other subjects that I don't want, I'm just giving the headlines, and then I'll give you the floor, and then hopefully we'll come back to this. I think that, so again, one is education. The second point is that I think that investors, when they join the deals, are paying extremely overpriced prices for what they're getting, okay, and I'll be happy to dive into this. And the third is that I think that this is a space that the regulator should not step out of. I think that a regulation is important way more than what it's done now, but again, I'll get to those points further later.
Brilliant. So I've got 5 so far, which I'm going to do in reverse order in Chinese. No. So just to recap where we are in terms of regulation. If somebody wants to invest in what's called a non-readily realizable security, and the point I would make is there's a very wide range of non-readily realizable securities out there. They have to put themselves into one of 4 categories. It's always been the case you had to be a high net worth individual, a sophisticated investor, or somebody who's got advice. And anybody who's got advice today has got a decent amount of money, so they are automatically high net worth individuals and sophisticated investors because they couldn't afford an advisor otherwise. The 4th category of restricted investor may only invest up to 10% of their net investable assets, which would not include their pension, their home, or their life insurance. So already, across all investments they do on any form of securities, there's a 10% cap in place. And then they have to go through the appropriateness test, which you've obviously been and looked at, which is fantastic. So there may be some semantics or wordsmithing there, but 80% of people who go through those platforms don't pass the test, and 20% of the people don't. So we're already in a situation where it's fully regulated by the FCA. Each platform has got direct authorization in place. We've got all the rules you'd expect around client money and everything else. And we insist on people going into one of these 4 boxes, capping them at 10% if they're not experienced or wealthy, and making them pass a test. So we think that from our perspective, those regulations are appropriate, and it's a much higher level of regulation than peer-to-peer lending. And you might argue that at the moment, as it stands today, peer-to-peer lending tends to be focusing on businesses that have 3 years' worth of audited accounts, and where Experian have given us a view on what the risk is that's involved. But there's no restriction on how much you can put into lending, and there's no requirement to pass any kind of test to do it. Meanwhile, the profile of equity crowdfunds is changing dramatically. The average size of raise last year was 192,000, and then 2015 was over 550,000. The average age of company is now over 3 years old. So what we're seeing is more and more mature businesses beginning to look at this as a cost-effective way of raising money, and we would argue that the Crowdcubes and the Cedars and the InvestEnds and others will be nibbling at the heels of AIM, simply because it can be a much more cost-effective way of raising money. So the challenge, I think, with the regulation is where you draw the lines. And our argument was that you should look at the risk of the end asset where the money is going. Then you should look at the risk of the financial instrument. It might be equity, might be debt, might be senior, might be junior, might be secured, might be unsecured. And then you should look at the length the platform goes to protect the investors. And on that basis, you should then impose whatever level of restriction appropriate to who those investors are and how much they can put in. So that was too hard for the Financial Conduct Authority. So they came back and said, well, if it's a security, it's in box A, and if it's a loan, it's in box B. Now, we're hugely in favour of the tiered system. We do think regulation should be appropriate and proportionate to the risk, but that's a fairly crude split, and we think times may change. In terms of the education, I think the appropriateness test in itself does something. There are constant moves by the industry to prove education. The UK Business Angels Association announced this week a form of accreditation for investors, which has got nothing to do with how much money you've got or whether you're a VC, but a lot to do with whether you understand exactly what you described in terms of the general failure rate of very early stage businesses, which, as you say, can be more than half. The issue around liquidity, which is something we're all very, very focused on, and the fact that you can't sell it the next day. And the diversification, and I would argue strongly that we offer a lot in the diversification argument because the minimum investment amount is so low. Trust me, Darren and Crowdcube are not really going out and marketing to people with £100 to put in one startup. The reason why the investment is so low is to allow people to choose to, if they want to, invest directly into businesses that they like, possibly in an industry that they know well and have worked in for a while, where they may have a little less expertise in terms of investment, but a lot of expertise in terms of that sector. We see the rapid growth of angel-led investments in places where there's a lead investor in place who knows what they're doing and the crowd can follow. And we also have nominee structures in place. It is a very diverse market, and the point is people can take whatever level of risk they want to take with their money. So I think this idea of, it's sometimes called an everyday investor, I was talking to Karen at Cedars earlier on, she feels restricted investor is a more accurate term because they've already been categorized, they've already been through the appropriateness test, and the education is there and is ongoing. So I think overall we could always do more. And we are debating at the moment with Treasury, who are very keen to put equity crowdfunding into the ISA. I can't wait to see what your views are on that. But the premise is, so long as they can understand that risk, they shouldn't be stopped from taking it.
Well, I passed the test, I think, in 15 seconds, unless I
damn
missed.
well hope so.
Yeah, unless I missed something. So I'm not sure that I was that impressed with the test that they need to pass, and I'm actually surprised by the 20% that failed. I think that when you look at an asset class like this, unless you say this is a way to stimulate the economy and basically it's somewhat of a donation-based crowdfunding, you need to look at the upside and the financial of the outcome. And I think that basically if in most of the deals, a restricted investor, and I specifically focus on those, okay? So if someone put 100 pounds into a deal, and he's getting, in many cases, I think the term was Series A or Series B, or Category A or Category B, or some, he gets the lower level of shares, which basically does not allow him to participate in future rounds, and does not provide him with liquidation preferences. He just gave basically about 90% of the value of the share of a preferred share. So a VC would never invest in such a share, and early stage investment, the most important right, and Fred Wilson from Union Square Ventures said that basically the early stage investment is you buy, the majority of the value is you buy the option to invest in the later stages. Because a company goes through Series A, Series B, Series C, Series D, you want to get to what is called a Series Z, which is, or Series Z, that's probably what he called that, because that's when you actually make the money. And that's why in private companies, you value options given at the time of a raise of common shares at about 10% of the cost of the price of preferred shares. So basically, the same investor that got for the same price per share, this share that does not have those two very specific rights, just pay the same price for something that is worth 10%. And if an investor in early stage, a good investor, a good VC, makes, say, an IRR of 20%, then this specific investor has no chance of making, even on average, his money back, okay? Because again, he bought inferior product to, I'm not talking about even valuation, but even if he bought into the same valuation as preferred shares coming at the same time, he bought an inferior shares, and which completely limits his chances of making money.
Which would be completely disgusting. So the whole idea is that it needs to be done pari passu, and there should be only one class of shares that are available. And this is why models with nominee structures are getting more and more popular, started by Cedars, Crowdcube have them now, and various others. And really what they do, and you pay for them, is that whilst you're the beneficiary and the shareholder, there's a nominee there who represents you on the board of that company. And it's really there to protect against rapid dilution and other things. Now, what it means is that whenever money comes back in your direction from the company, the platform is going to take 7.5% at the same time. But that's fairly irrelevant in the context of what you could be losing out. And to quote Jeff from Cedars, he's not worried about people losing money when a company goes badly. He's worried about them not getting their share of money when it goes well. So I think that the market is evolving very, very quickly, and we have many more angel-led models, many more nominee ones in place. I think people can really choose for themselves what level of risk they want to take with their money. And you mentioned the donation stuff. It's fascinating. I mean, donation crowdfunding, is wonderful. And if you are lucky enough to have a company or a product or a service where you can persuade people to pay in full up front for something you haven't made yet, then that would be the best plan. Why would you give away equity or take on debt which you're going to have to service if you can just fix your cash flow and get paid through? And again, we begin to see blended models there where people actually just really like the product or service the company's doing, really wanted to exist. The biggest UK example in the early days was Marillion, a band so unbackable that not even their record company would pay them to go on tour, but the fans were the fans and they funded it all the way through. This is one of the hidden values of crowdfunding from a business perspective, is that it effectively gives you a marketing platform as well as raising money at the same time. And it's commonly perceived as a soft way of raising money, but it is so transparent and can be very, very simple. And where I ask one question on a platform, somebody else will build on that. And if you're thinking of raising money this way and think you can just stick it on the platform and watch it roll in, that is an urban myth and it's never, never going to happen. Questions build on questions. Trillion did a raise. We had 76 streams of questions going on day and night, and you get hammered by those investors. So you get the pooled effect of multiple investors being able to see the question and answer going at the same time. To a question which came from the floor earlier on, there are many more clicks and bricks events now because some people do still like to go and look people in the eye before they back the company. But, you know, I'm almost digital native. We do a lot by video at the same time. We do a lot on phone calls, which are scheduled and set up. And I think the point is it's so open and transparent that if people can make their own assessment of the risk that's there and either go for it or not. And if you're more nervous and you don't feel confident, you can go to a platform where there's a lead angel in place. You can choose a nominee. There's many different flavours of crowdfunding, and my concern, I guess, is that people aren't really cognizant of how quickly it's maturing and how things like crowd rating from Modwena and All Street, this whole industry of support recognises the fact that unadvised investors really want to be in this space. 15.6% of the early stage money raised in the UK last year was through some form of equity crowdfunding all the way through. It's a non-trivial pot of money. We have had CDIS and EIS, which are the envy of the rest of the world in terms of tax breaks, and we know now that those are really being pulled away from more established asset-backed businesses back into the risk profile which is there. So I think we'll see more and more people coming to look at EIS investment through crowdfunding. And of course there's always the option to do it through a fund, but I think there's a real appeal to actually seeing where your money is going directly into business and feeling part of that. Angel investment, in my experience, I'm on my 7th startup, it was more about those individuals and their networks and a bit of mentoring and the contacts than it was the money. And this is really just angel investment democratized with technology behind it.
I think it's missing one main parameter, and we might not be that far away in terms of, definitely in terms of direction.
We have to pretend we are because we're on stage.
I think it's missing, there's one major parameter missing in the current interaction between investors, and again, I'm talking about restricted investors and the companies, because of which I think that taking regulations out of the equation, and basically the regulator saying, if you disclose that, or if you have them pass the test, or if you told them that it's illiquid, etc., you're off the hook, that's a very dangerous place to put the investors, because there's no balance of power between the investors and the company, or in the investors and the platform, those type of investors. I mean, we are catering only to accredited investors. That's completely irregulated. I mean, as long as we confirm that they are accredited investors, there's no regulations. We can do whatever we want in terms of soliciting them. But whenever we make a decision to invest, and the difference of our platform is that we see ourselves as VCs. So we screen the deals, we do the diligence, we put our own money in each one of the deals, and then we invite accredited investors to join us. Okay, so it's not anyone can get on the platform. And when we put the company on the platform, and if the company goes bad, which again, 40%, 50% of our companies are assumed to close business at the end of the day, then we're losing three things. Okay, we're losing our own money, we're losing our reputation, and if we did anything wrong in the process, okay, and we lost money of powerful individuals. Okay. The current situation of basically the regulator stepping out of the equation here and saying, as long as the platform asks the questions, etc., there's no power that stands against there's no one that stands against the platform or against the company if something goes bad, okay? Then, and the fact that the platforms actually see, at least for now, see the company as the customer and not the end user as the customer, not the investor as the customer. Again, with the nominee structure of them actually paying some of their fees for that structure, that's a good way forward. But that basically means that investor, if something went wrong, not in terms of the company did not succeed, but if something in the process went wrong, I don't know if that investor has any power against the platform like the situation that we have.
So I find it more scary that everything that you do is completely unregulated. So that's the regulator stepping out saying you're accredited, fair game, off we go. They're absolutely not stepping out. They firmly stepped in. I mean, platforms, just to pick two at random, Crowdbank and venture funders, both have skin in the game, either because they are investors in the early stage business or because they're deferring their fee. And the fees can be, 5-6% from a crowdfunding point of view. And that gives that alignment. And I think that is fantastic to have that alignment and know you're doing it together all the way through. If there is anything which we as a platform has done which is not fair, not clear, not misleading, if we haven't provided sufficient information, if it isn't easy to understand, if we haven't given a balanced view of risk and return, if we allow claims to be made which can't be substantiated, we are absolutely on the hook for the Financial Services Compensation Scheme and the FOS. So we absolutely have to get that right. And these are all retail clients. In the conversation about the ISA stuff earlier on, and we'll jury's out about whether equity goes in or not. I think in general as an industry, we feel that the downside protection is more appropriate for early stage through CDIS and EIS, given the failure rate. That's much more valuable to have. But we do see sectors such as property, which are not eligible, and where there are no tax conditions in place to do it. But what I would say is that they go through the process, the platform may well be aligned with them in terms of what they're doing. There is comeback, but these are all retail clients. And in the ISA world, we've argued, and we think we've won, that if a platform calls these people corporate finance contacts, not my client, not my problem, shouldn't be allowed in the ISA from that point of view. So all of these platforms have got the clients are the retail clients, they absolutely look after them, and many, many more have some kind of ongoing requirement to report back in the stuff that they're doing. So I think the regulation is appropriate, and the models are emerging all the time. And again, Modwena did a survey of the first 200 equity crowd funds against her panel of experienced VCs and angel investors, and said that there were 3 key metrics that she looked at, being the management team, the product, and the financials. And she said the crowd were aligned with her engine in terms of the management. They were aligned in terms of assessing the product. They were placing less emphasis on financials. And some of that is because we are so restricted in what we can tell investors about the future prospects of the company, because unless we can substantiate their claims, they can't make it. So that's possibly one argument against equity crowdfunding, is we're so over-regulated that we can't talk about the future prospects because we can't prove it's the case.
I didn't get the feeling that it's over-regulated when I played with this, but I think that the direction that you are heading to is definitely solving some of the issues. Okay, I think that if there's going to be a structure that the retail investors will be protected by someone that has the power to protect their rights, that's one. Second, if they get the same product, same shares, which they don't now in many cases, okay, or again, I don't know the statistics. I mean, looking...
I'm not aware of any currently at the moment, whether there's 1 and 2 anomalies. A couple picked up at the end of 2014 and very early 2015, but that's really not the norm.
Okay, so I mean...
They're on the panel next, you can ask them. They're all here.
Maybe they'll just address that without the question. But I think if they get the same product, if they get educated, and potentially if they're structured, built to diversify them, for instance, by default, okay? And again, whether that happens organically or not, that's a question. But then I think they have better chances of making money. It's still not necessarily the best asset class for people with not a lot of money, but then it's their choice whether they do that or not.
We've run out of time, and we've actually almost, you're not quite agreeing, but you're edging towards each other, I have to say.